Hello, my fellow investors, and welcome back to another viewer-requested fundamental analysis video. Today, guys, we are going to be bringing back something that, if you guys know what this is, man, you've been here for a long time, But we're going to be bringing this back, and what I'm talking about, it is the wheel, because, well, I like taking your guys' recommendations. It opens up my whole entire vision when it comes to knowing new stocks I probably never even heard of before. And you never know, right? You never know. It may be a stock that I like, or maybe a stock that somebody else likes. So I'm going to be bringing back the wheel. There are 3 companies on the wheel that I would like to see which one we get for today. So before we get started, of course, make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. Make sure to follow us on X at Fatal Investing, and if you would like to join us on the Discord, the link is in the description below. So with that said, guys, let's actually get started with choosing this stock. So here we have the wheel. Yeah, we're bringing this back. I absolutely love doing this. So let's spin the wheel and let's see which of these 3 companies we are getting today to do an analysis on. And it looks like, guys, we have Hershey, HSY. Now, this company was brought up by Tony. Here's the comment where he recommended this. And I believe this is actually the next one in line that I was planning to do anyways. So it just so happened that, you know, the wheel picked it. So we're going to take a look at the company Hershey. It's a company that, oh man, I know I've done it before, and I know every single time I've done it, I'm always fairly surprised by it. But this will be the first time that we get to look at it in the 10-year perspective. So I'm actually really interested in that. So with that said, let's actually get started with this analysis. So guys, here we have the company Hershey. Now this company, I don't think it needs any introduction, right? It's Hershey. Chocolate, you know, the chocolate bars, the Hershey Kisses, the amusement park here in Pennsylvania, and their headquarters as well. Which, by the way, if you've never been to Hershey's Chocolate World, my recommendation, guys, is do not bring a child with you, because they'll make a chocolate bar the size of your child's head, and you're gonna be spending a whole lot of money, So, you know, just be wary when it comes to that. If you're visited, you know, just FYI. But you know, it's a company that really doesn't need any introduction. It's a staple. It's an American staple, just like Coca-Cola, right? Just like Walmart. So it's very common name here in the United States. So I really am curious as to see what the calculator actually says. So with that, let's actually get started with their earnings, because they did have earnings on just May 3rd. And Hershey beats top and bottom line estimates, reaffirms fiscal 2024 outlook. So we can see that the Q1 non-GAAP EPS of $3.07, that was beat by 31 cents, and revenue of $3.25 billion. Guys, that is up 8.7% year over year, beats by $140 million. Organic constant currency net sales increased 8.6%. When it comes to the fiscal year outlook, the company is reiterating its net sales growth, reported earnings per share, and adjusted earnings per share outlook for the year. So net sales, actually, the 2024 full year outlook is current guidance. The net sales growth, you guys can see 2 to 3% versus the estimate of 3.43. So that one is a little bit lower than the estimate. Reported earnings per share growth 0, adjusted earnings per share 0. And then for 2024, that's a little bit weird. I don't know why they're doing it like that, but nonetheless, though, for 2024 projected, the EPS diluted is between $9. Oh, I see. This is just, why do they have this? Okay, that's a little bit strange. But reported EPS, they're estimating between $9 to $9.11. And, well, in 2023, apparently it was $9.06. Let me see. Well, I don't really know what else we got over here. Nonetheless, so you guys can pretty much see that our company is really winning right now, especially when it comes to this massive revenue beat of $3.25 billion. So let's come now into the calculator. We got the ticker for HSY, market cap of $37 billion, a PE of 23, which, guys, I'm actually recording this as the market is open, so you're gonna see the numbers change here and there. But this is actually the current share price of $183.11. And this is absolutely remarkable because the company is actually near 52-week lows, which is probably why Tony told me to actually take a look at this company. He usually gives me companies near 52-week lows, which I really do appreciate. Yeah, 52-week low of $178.82 and a high of $251. On the 1 year, they're down 29.47. Year to date, down 1.67. And if you guys take a look at this, guys, they have been consolidating at around this point since October of 2023. COVID lows was essentially $110, kind of. I really can't get that right there, but it's around like $110. And the high, it's actually occurred at around what, May 5th at $275.33. So they're significantly down since then, right? They're significantly down since then. And the fact that they're at 52-week lows, it may actually show as a pretty good buying opportunity. Very, very nice. Now let's come back over here. They do pay a dividend of $5.48, which is a yield of almost 3%. Okay. Payout ratio of 49.38. 5-year CAGR of 12.15 and 14 consecutive years of dividend payment. Ex-dividend date passed as of May 16th. Payout date was on June 14th, and they pay their dividends quarterly. Based off of the current shares outstanding and this $5.48, they pay out, guys, nearly $1.11 billion in dividends every single year. Take their 10-year average free cash flow, subtract that number, and they're left with $95.08 million. That's not good. Now, take the last year's free cash flow, it shoots all the way up to $444.04 million. These payout ratios are a little bit concerning. Last year's free cash flow is 71.39, and the 10-year, it is 92. So here's where we have to take a look at these graphs, because for all we know, this could be a pattern or it could just be a blip. Obviously, you would expect the 10-year to be a lot lower, or I guess a lot higher when it comes to the payout ratio, because the cash flow 10 years ago was probably a lot worse than what it is today. So if it is the case, then great, which obviously it is. I mean, we could see that right here, right, between these two numbers, but I want to see by how much. So now let's get into the graphs. So here we have, guys, the graphs, starting, of course, with the net income. I got to say, these things look pretty good. We got 10 years ago of $847 million to 1 year ago of $1.86 billion, increase of 120%. You had two instances here where it did fall a little bit, 10 to 9. That was so long ago, I don't really count it as much of anything. And then from 6 to 5. So that's what I'm going to give this, guys, a 90%. Really, really, really solid graph right here when it comes to the net income. The free cash flow, yeah, it's a little bit more wonky. You have a little bit more ups and downs, more ebbs and flows. Nonetheless, though, it's going from 473, you guys can't see that, I am so sorry, $473.6 million to 1 year ago of $1.55 billion, increase of 228% with an average of $1.2 billion. So this is exactly what I was talking about, right? The cash flow is very much increasing. I look at this, obviously, you know, the average is going to be a lot lower because, well, 10 years ago, it was a lot lower than what it is today, right? Up until 7 years ago, actually 6 years ago, it was under $1 billion when it came to the free cash flow. So this is not really surprising. The one point of concern is the fact that they did go down from 2 to 1 year ago, but as it currently stands, it may actually just be continuing to go up because you do see that in regards to, for example, 9 to 8, and then from 5 to 4, COVID related maybe, but still, you guys get my point. This may just be a blip. As of this year, it may actually be a lot higher. So I'm going to give this an 80%. Looking now into the revenue. The revenue's actually, it's essentially perfect. You had one little bit of a blip, but it was so tiny and it was so long ago, I don't really count it. We got 10 years ago of $7.4 billion to 1 year ago of $11.16 billion, guys. This is an increase of 50.44%. The one little time that they dipped down from the previous one was 10 to 9 years ago, where it went by, what is that, like $40 billion, I would say, roughly, not 40 billion, sorry, 40 or $50 million difference. Guys, that's not much at all. That's not much at all. I'm going to give this 100%. Really, really solid looking graph overall. Now, here's the assets as a reference only, nicely increasing. And the liabilities, also nicely increasing, which is not what you want to see. But when you take a look at the assets minus the liabilities, it actually doesn't look half bad. You can see that the graph is, once again, nicely increasing. Now, you can see that from 10 to 8 years ago, it was decreasing, but ever since then, they were just shooting it up there. Average total assets of 8.4 billion, liabilities of 6.24 billion, and a difference of nearly $2.2 billion. Unfortunately, though, the cash flow minus the liabilities is coming down. Now, you do see there are instances actually in most recent years too, of it actually coming back up to zero. But the overall trend, it is to decrease. In fact, as of 1 year ago, they're at negative $6.25 billion, where the average is negative $4.84 billion. I'm going to have to give this guys a 60%. It's not what I want to see. Now, what I do want to see is these shares outstanding. This is amazing. Look at this. We got 10 years ago of 221 million shares to today of 202.2 million shares. Million shares, guys. Million with an M, not billion, right? Not billion, but million. On the 10-year, this is a buyback of a little bit more than 8.5%. Previous year to the current year is a buyback of 1.08%. Now, the reason why I like this is the fact that, guys, this trend line is basically touching each of these graphs every single time. Y'all know I love that because it shows consistency to such a degree that it gives a lot of security. Right, it's a lot of certainty that comes from this. The fact that they will continue to do this throughout the coming years, and the more shares that they buy back, the higher, or I guess the higher the dividend they could make, but also the easier it is to pay that dividend. This is an easy, guys, 100%. Beautiful, beautiful graph. And lastly, cash and equivalents. They currently hold $520.4 million with an average of $485.4 million. Overall grade, I'm actually surprised this is not a 90 plus, 88%. Probably because of the free cash flow. It's just a bunch of up and down, but I think it's all good at the very end. The cash flow minus the liabilities will also be fixed if this were to get fixed. But guys, 88%, really, really solid, right? This is not an A company, but it is a very high, I guess if you want to use ratings, triple B, right? Triple B, maybe a B plus, B plus kind of company. Really, really good. Now, here's the thing. With 52-week lows, is this a good price right now to buy? Let's find out, because I'm very curious to see these numbers. And if we take a look at now the discounted free cash flow, this is crazy. This is absolutely crazy, guys. Look at this. Not adjusting for the $240. Wow. And then adjusting for debt, I just sounded like the meme guy. And then adjusting for debt, $217.26. So let's input some numbers. Let's input some numbers for this thing. Let's start off with the predicted share buyback. I think it's very, very easy to see what we're going to do here. 0.5 buyback for the lowest, 1% for the median, and then 1.5% for the highest. Guys, I think, sorry about that. And I personally think, guys, that this is very fair. I think that this will 100% happen in the next 10 years because we've seen this happen, right? We've seen this happen. So I think this will 100% happen in the next 10 years unless something catastrophic happens. Now, for the revenue is also very consistently increasing as well. That's why I actually love these types of companies that are just so perfect when it comes to their graphs, that the trend line matches those graphs, because it's so easy to figure out whether or not it's fair value, right? So when it comes to this, let's say 3%, then let's go up by 2, then let's go, let's say 5%, and let's say let's go up by 2 again, and let's say 7%. Guys, I think this is very, very fair, and you guys can see these numbers. These numbers are crazy. These numbers are absolutely crazy. The required rate of return, right? What price do we want to pay for this, or what kind of required return do we want for this? It's Hershey. It's not a tech company. You can only reinvent the chocolate bar so many ways, right? But seeing that it is on the 10-year, I at least want to beat the market at this point. And in doing so, I want to put in 12%, right? At least just beat the market, the minimum, right? If it's a tech company, I'm putting in like 20, 30%, right? But look at this. This is actually really interesting. We got $90.31 to $133.04, not adjusting for debt, and adjusting for debt $66.10 to $106.26. Margin of safety of $5.10.15, $56.18 to essentially $101. Guys, the current share price is $183. So assuming that these numbers actually come true, which honestly, I think that the median assumption is by far the one that's most likely to come true. Seeing this, right? Seeing their graphs, the consistency of it, it's looking overpriced, right? It is looking a little bit overpriced, but honestly, not by much. At the current state of things, seeing the fact that this is a 52-week lows, this is a company that I personally, if I was beginning to buy this company, I would begin to buy it right now and then just continue to dollar cost average if it continues to go down, because I don't really see I don't really see a point or a reason as to why you wouldn't do that right now. Now at $200, what it was, or $275 as it was at peak, yeah, that's a hard no. That's a hard no. But right now, 183, and it is coming down to 52-week lows. I'd rather just pay that premium of whatever that difference is of like what, $71, $70, just to get into this company right now. And if it continues to fall, me personally, I would just continue to buy. Again, that's just my personal opinion. I'm not telling anybody what to do. Please do not get the idea that I'm telling you guys what to do. I'm just telling you guys, based off of my assumptions right up here, what I would do, right? Calculator is available for free. The 5-year one is available for free for all of you guys. And you guys can make your own assumptions for yourselves. Please do. I highly encourage you to come up with your own grade for yourself as well, because not financial advice, every investment is the present value of all future cash flow. And if we take a look at this dividend, guys, look, 3%, right? 3% really good, right? Just think about your bank giving you a 3% interest or yield on a 3% interest in your savings account. Non-existent. Well, you're getting it with Hershey right now, and putting in $6,215, this nets you almost $200 extra a year, guys. That's really, really good. And on a quarterly basis, essentially $50. Not too bad, in my personal opinion. So as it stands, I get that Hershey, guys, has controversies. Name me one company that doesn't. I like the fundamentals. The fundamentals are nearly there. It's a 52-week lows. The calculator is showing that it is overpriced, but honestly, for me, I think I would just take the small premium loss and go for it, right? And go for it. Absolutely. I really do like the fundamentals. The fundamentals look perfect. Well, not perfect, but you guys get my point. It's really good. So thank you so much for the recommendation, Tony, for Hershey. Make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. Make sure to follow us on X at Fatal Investing. And if you'd like to join us on Discord, link is in the description below. So with that said, guys, peace out, and we will see you all next time.